Right now, at this very second, you are likely glancing at your smartphone, checking that green percentage number on your brokerage app. You feel a sense of calm, don't you? You think that number represents your safety, your future, your retirement. But what if I told you that you aren't looking at a fortress? You are staring at a glass castle built on a fault line. Most of you believe you are diversified investors because you own an index fund. You think you've bought a basket of 500 separate companies, but you haven't. You are actually holding a grenade with the pin halfway pulled out. This isn't about market fluctuations. This is about a structural lie that has convinced millions of people they are safe, right before the floor dissolves beneath them. I've seen this before. I saw the blood in the streets in 1999, and I saw the despair in 2008. If you want to know if your portfolio is actually a ticking time bomb and exactly how to defuse it before the clock hits zero, you need to watch every second of this briefing. Subscribe now, because we are about to dismantle the illusion. Let's start with the first victim. I call him the growth optimist. You know this person. Maybe it's your neighbor. Maybe it's you. This investor is addicted to the dopamine of the green line. They look at a chart of NVIDIA or the latest AI darling, and they don't see a company. They see a lottery ticket that never loses. They think they are investing, but they are actually standing in a casino, putting every single chip on red 7 because it hit 3 times in a row. This is the illusion of invincibility. When you pour all your capital into the hottest tech stocks, you aren't building wealth. You are building a skyscraper without a foundation. Think about it. When a portfolio like this turns, it doesn't correct by 5%. It doesn't gently descend. It crashes like an elevator with the cables cut. Just ask anyone who held Oracle in 2000 or NVIDIA during its 60% drop in 2022. It wasn't a dip. It was an amputation. I didn't learn this from a textbook. I learned it the hard way. Picture this, 1999. I was a Marine corporal, barely scraping by on $1,300 a month. That was my entire world. But on the screen, I was a king. I poured every single dime into .com stocks that had no earnings, no product, just a cool name ending in .com. I remember staring at the ceiling of my barracks, doing the math. I was going to be a millionaire before I made sergeant. It felt like magic. But then, the music stopped. It didn't go down slowly. It evaporated. My account didn't just shrink. It looked like a bomb went off inside it. That silence, staring at a screen that had destroyed years of my labor, that is the ghost that haunts this channel. And the terrifying part? I see that same look in your eyes today. So, how do we pull the pin back into the grenade? If you are the growth optimist addicted to U.S. tech, you need an antidote. You need the geographic cure. Specifically, the Vanguard Total International Stock Index, or VXUS. Don't think of this as just buying more stocks. Think of it as installing an oxygen mask in case the cabin pressure drops. Right now, the U.S. market is priced like a luxury penthouse, expensive. But the rest of the world? It's on a fire sale. We are talking about a valuation gap where you can buy international companies for 17 times earnings, while U.S. tech is trading at astronomical levels. It's like finding a dollar bill selling for 60 cents. Plus, if the U.S. dollar collapses, which happens historically every few decades, your U.S. stocks crumble, but VXUS? It acts as a shield. But maybe you're sitting there thinking, Joseph, I don't buy crazy tech stocks. I'm safe. I just buy the S&P 500. Oh, you poor soul. You have no idea what you've actually bought. Now we arrive at the most dangerous trap of all. I call it the silent killer, the VO portfolio. You are probably sitting there, arms crossed, thinking, Joseph, I don't gamble on meme stocks. I'm responsible. I own the S&P 500. I own the entire American economy. You are wrong. You don't own America. You own a volatile tech startup wrapped in a U.S. flag. Here is the math that Wall Street glosses over. Right now, just 9 stocks make up 37% of the entire fund. Think about what that means. You believe you are diversified across 500 separate companies. But in reality, for every dollar you put in, nearly 40 cents is funneling into the same crowded trade as everyone else. This is concentration risk hiding behind big numbers. If big tech sneezes, your safe retirement plan doesn't just catch a cold, it gets pneumonia and ends up in the ICU. This happens because of a fatal structural flaw in the index itself. The S&P 500 is what we call capitalization weighted. That is just fancy talk for a momentum trap. It means the bigger and more expensive a company gets, the more of it the index forces you to buy. You are structurally guaranteed to buy high. Picture a pyramid standing on its very tip. That is your portfolio right now. Massive weight at the top, supported by nothing at the bottom. It is inherently unstable. While the news headlines scream about the top 7 companies, the other 490 companies, the manufacturers, the energy producers, the banks, are being ignored. You aren't investing in the real economy anymore. You are just chasing a bubble until it pops. So, how do we fix a broken structure? How do we flip the pyramid back over so it doesn't crush you? So, how do we fix a broken structure? How do we flip the pyramid back over so it doesn't crush you? Enter the equalizer. This is the Invesco S&P 500 Equal Weight ETF, ticker RSP. Think of this fund as the adult in the room. While the standard S&P 500 is drunk on the popularity of a few tech giants, RSP is sober. It forces every single company, from the trillion-dollar tech lord to the boring utility provider, to have the exact same vote in your portfolio. It is a discipline machine. When the tech giants get too expensive, RSP automatically sells them off and buys the cheaper, ignored companies. It buys low and sells high for you, without you lifting a finger. The proof? In the brutal sell-off of 2022, while the standard S&P 500 collapsed by 16%, RSP only fell 7%. That 9% gap? That is the difference between panic selling your future and sleeping soundly at night. But wait, you have the global safety of VXUS. You have the structural balance of RSP. You must be bulletproof now, right? Wrong. You have just walked into the final trap, the all-stock hoarder. You have conquered geography and you have conquered valuation, but you haven't conquered human nature. Here is the ugly truth about the stock market. In a crisis, correlations go to 1. That means when the panic hits, it doesn't matter if it's a US stock, a European stock, or a value stock. They all hold hands and jump off the cliff together. This is volatility risk. If you own nothing but stocks, you have no shock absorber. And worse, there is cash flow risk. When the market crashes, dividends get cut. If you need money to live, you are forced to sell your shares at rock-bottom prices. You are cannibalizing your own factory just to pay the electric bill. And then there is the nightmare scenario: fraud and stagnation. Do you remember Enron? WorldCom? They were the safe blue chips of their day until they became worthless paper overnight. Stocks can go to zero. But even if they don't die, they can turn into zombies. Take a look at everyone's favorite hero, NVIDIA. Before its recent explosion, Did you know it was dead money for nearly 15 years? From 2000 to 2015, the stock price went nowhere. Nowhere. If you were retired and relying on that stock for income during those 15 years, you starved. You cannot eat potential. You need assets that are not stocks to protect you from the long, cold winters of the market. You need a fortress. So, if stocks are the soldiers fighting on the front lines, getting shot at every day, who is the medic? Who is the bunker? You need the fortress builders, specifically bonds and real estate, represented by tickers BND and XLRE. I know, bonds are boring. They aren't sexy. But you want boring when the world is burning down. When the stock market crashes, panic sets in. Investors flee the chaos and run to safety. That safety is bonds. Historically, when stocks tank, bonds hold firm or even go up. They are the counterweight that keeps your elevator from hitting the basement floor. And then there is real estate, XLRE. This is your landlord. It doesn't care what the stock ticker says today. It cares about rent checks. During the pandemic crash, while tech portfolios were bleeding out, real estate was quietly paying a steady 3.3% dividend. That is cash flow. That is bread on the table when you have lost your job and your stocks are down 40%. These aren't just tickers. They are the concrete walls of your financial home. Without them, you are just camping in a hurricane. Now, I want you to stop. Don't just click to the next video. We need to conduct an audit. I want you to look in the mirror and ask yourself, which victim are you? Are you the growth optimist, gambling your retirement on a green line that you pray never stops? Are you the passive victim, blindly trusting an S&P 500 that is structurally broken? Or are you the all-stock hoarder, thinking you're diversified when you're really just exposed? Don't let this video go in one ear and out the other. That is what the losers do. Winners take action. I want you to go down to the comments right now and type your investor type. Admit it. Own it. Because once you admit it, you can fix it. This is the path forward. You take the global safety of VXUS to escape the dollar trap. You use the discipline of RSP to balance the scales, and you build the fortress walls with BND and XLRE to survive the winter. You are no longer a gambler throwing dice in a casino. You are an engineer. You are an architect building a wealth structure that can withstand an earthquake. If you want to see exactly how I allocate these funds in my own personal portfolio, I've shared the full breakdown on the Blossom app. Go check it out. It's time to stop hoping for the best and start planning for the worst. Because when the glass castle shatters, you will be the only one left standing. Let's talk money.